Thanks so much for tuning in to Alpha Moguls, a show where we speak to some of the finest investing minds about how they are looking to generate alpha in their portfolios. Our guest today is Nilesh Shah of Envision Capital. Nilesh, great having you. It's been a while. Thanks for joining in.
Thank you, Neeraj. Pleasure is mine as well. And great to be on the show again. Thank you so much, Neeraj.
The pleasure is ours. So, Nilesh, the simple question, the way we start the show usually, how is it that you're approaching the current investment climate and looking to build the portfolio so that it can create significant alpha over the course of the next 12 to 18 to 24 months?
Well, Neeraj, what it looks like clearly is that, unlike the past when, we were just one more emerging market and we were in a way recipient of global liquidity and some of those, I would probably say the non-earnings, non-fundamental factors. This time around, the tailwinds are a lot more about the economy and earnings growth. And this is getting manifested in the fact that for now several months, the last 5 to 6 months, we've clearly seen, foreign investors, FPIs out there continuously coming and selling and being net sellers. And despite the markets have been trending up, holding up, and clearly that to me is a reflection of the underlying strength in the economy and the earnings kind of environment. Number one. Number two is that, Neeraj, in the past, we've seen this whole market uptrend being so narrow, just one or two sectors in a way calling the shots. And it was you being more of overweight or underweight in those kind of one or two sectors. Versus that, I'm seeing a very, very broad-based set of participation from a variety of sectors. So to that extent, as a portfolio manager, as an investor, I have lots to pick and choose from. This is not about just being wedded to the consumer sector or to the private financials. This time it's a lot more. And that essentially is, in a way, driving our construction of the portfolio and driving our investment strategy. In terms of themes, conventionally, India has been more around just the 1D, which is essentially demographics. Which means anything to do with India's favorable demographics became a good long-term investment opportunity. And of course, this D still remains, and I think it's a story for the next several decades. This is not a multi-year kind of an opportunity, it's a multi-decadal opportunity. In addition to this 1D, I see the addition of 3 more Ds which have essentially come in. The first one around deleveraging. I have not seen corporate India so deleveraged. And that clearly is a function of improving outlook, as well as strong liquidity and increased risk on by investors. And therefore, your ability to raise money from secondary markets to IPO markets by inviting strategic partners and giving them a share of your business, all of this is essentially leading to deleveraging. And to that extent, this deleveraging is basically creating capacity for future capex, future growth plans. So that's one. The second one is around digitalization. That digitalization is helping the nation as a whole. It's helping the government, it's helping enterprises, and it's helping individual citizens and consumers. So to that extent, that's providing the additional tailwind, helping businesses to grow, helping consumers to come in and out there participating in the growth story. And the last D is around decarbonization. That to me is, in a way, again, creating a broad set of opportunities for investors. So I clearly see a confluence of these 4 Ds, which are really playing out and essentially, in a way, providing opportunities for investors like us to basically invest, to cherry pick sectors, cherry pick businesses, and in a way invest, going forward. So this is really the way I'm seeing how I see the things, the times ahead, to be very different versus what the times have been over the last several years.
Interesting. I'll get to the nuts and bolts of some of these, Nilesh, but just a brief question. I know you construct a portfolio not from a point-to-point 12-month perspective, but I'm just trying to understand that in order to generate the alpha that you always look to, the return or the return should beat the returns of the benchmarks. Do you reckon that the benchmark returns themselves will be a lot more moderate this year, and therefore the return expectation that investors should have, whether through investing through experts like you or themselves, should be a bit lower because we coming off a period of 18 months of supersonic returns, so to say?
Yes, absolutely, Neeraj. I mean, if I were to kind of look at, the PMSs that we manage, and over the last 1 year, our returns on a 1 year rolling basis have been between 55 to 60% on a last 1 year, not the last 1.5 years. 1.5 years is a lot higher, but last 1 year is around that number. Now, that's something which is very unlikely to repeat itself going forward. And if I were to basically look at, say, the last 3 to 5 years, the returns have generally been more like, say, 15 to 20%. My view is that maybe going forward, it's quite possible that we may go through basically 6 to 9 months of a very flattish performance. That's quite possible. Over the next 1 year, the returns could be very muted. It could probably be towards the low end of the double-digit returns. I'd probably say more like, it could potentially be. I mean, of course, it's always hard to kind of really, in a way, project what it's going to be. But my sense is that it is going to be towards the lower end of the historical range for the next 1 year or so. And I clearly believe that over the next 1 year, I see several headwinds for the market. One is, of course, the markets have itself run up, prices are higher. A lot of the next 12 months outlook is getting factored in. There are, of course, the X factors like the US Fed and those kind of things, Omicron and those kind of things are going to play out. So the market is going to need some time to digest some of these risks or some of these headwinds going forward, which could basically, in a way, dilute the return outlook. And then once we, I think, go through 6 to 12 months of phase, then probably after that, we get on to basically the kind of mid double-digit return kind of an outlook. That's the way we're really seeing things shape up over the short to medium term.
Got it. Nilesh, now the dichotomy that we've seen and between how the construct of the large cap indices are versus what portfolios could be in themes or in buckets wherein there is a larger dominance of the broader end of the spectrum, is that financials tend to lose their percentage edges compared to a Nifty benchmark, so to say. Just by virtue of the fact that, as you said, the plethora of opportunities in the non-Nifty side is just so wide that the options are just much more. My question is, when you are constructing your portfolio now, or the portfolio construct of your portfolio now versus, say, what it would have been 12 months, 18 months before, is it remarkably different in terms of the weightages that you're assigning to any large overweight that you may have? And in terms of the number of themes present in the portfolio versus what it was in the past?
That's a very, very pertinent kind of a question because, all along all these years, one would just try to see that, how does, I mean, if I were to kind of just look at private banks, their weightage in the large cap or the broad-based indices used to be north of 30%, more like 35% and things of that kind. And therefore, saying is that, that's actually a tough call to make, especially for investors like us who are more bottom-up, are always looking out for some very fundamentally driven bottom-up opportunities. And you really don't take a call based on, what the weights are in the benchmark. So obviously for portfolio managers like us who follow a very benchmark agnostic kind of a strategy, in a way, it used to be a bit more challenging in the past. Versus that, I clearly believe now that given that that the opportunities have spread beyond the private banks, in a way is pretty positive and heartening for, benchmark agnostic strategy like ours. And I clearly believe that private banks, it's not that we don't own them. We do own HDFC Bank, we do own ICICI Bank. But in a way, I clearly believe that their probably fundamental outlook is going to be a lot more challenged going forward. And why I say this is, of course, because number one is within the private sector banks, it was just two banks who were in a way really the most efficient. Versus that, so it used to be HDFC Bank, Kotak Bank. Now it's also ICICI Bank, Axis Bank, in a way which have in a way dealt with their legacy issues and are pretty much spruced up for essentially growth. And you're beginning to see that in the numbers. Number one. Number two, PSU banks have in a way also kind of engaged in substantial cleanup act in terms of the asset quality issues. And if the privatization program happens, clearly which the banking space dominated by two players, you suddenly see the banking space now. There's competition from 8-10 meaningful players out there. On top of that, you have fintechs who seem to essentially be raising billions of dollars. I mean, finally, in the lending business, what do you need? You need credit, you need capital, right? And if money is so easily available to you, you go out there and lend and things of that kind. So overall, and then on top of that, you have the payment guys who are again coming in and finding, in a way, finding the gaps in the value chain and going out there lending money to merchants and SMEs and all of that. So that space is becoming hugely competitive. So, and then of course, last of all, that in a way, investors are loaded with private banks, in the sense that if you look at any of the large portfolios, large managers, what's the one sector on which they have enough? It's banks. Okay. So I clearly believe that in a way, it's good, it's heartening, honestly, it's good news for bottom-up benchmark agnostic strategy like ours.
Yeah, but so the second part of the question, Nilesh, therefore, is the construct a lot more dispersed and widespread, or could it be that your most overweight position could be a very large part of your portfolio even now compared to what it was, say, 18 months ago, and why?
So in a way, the portfolio is not as concentrated as what it used to be, Neeraj. So earlier we would run a portfolio between 12 to 18 positions, more like 15 positions. Okay. So it used to be as concentrated or as focused as that. Versus that, today it's basically around 25 positions.
Wow, okay.
It's got as spread as that. And because earlier you did not have enough opportunities in the digital space. Similarly, on the decarbonization side, the capex side, again, you did not have enough opportunities. And obviously, of course, the investment cycle itself was in a way moribund for so many years. But now you again have a world of opportunities there. And then third, of course, even within financials, so many years back, you did not have choice. I mean, apart from private banks, there was no meaningful choice. But today, you have so many insurance companies listed. You have so many AMCs listed. You have so many well-run housing finance companies listed out there. And so therefore, it's just adding to the universe, your investable universe. And therefore, you have the ability and the flexibility to kind of have a slightly more broad-based portfolio than what we were running conventionally.
Okay. Let's talk about the digital theme. You mentioned it twice, thrice, and we'll talk about IT services too in the second breath of this conversation, Nilesh. But first, this whole digitalization theme, and there are multiple ways to play it, I reckon. Which is the path that you've chosen and why, and how long or how long lasting do you think this opportunity could be compared to the valuations that it offers?
Yeah. So clearly believe that digitalization essentially is, honestly, again, probably the opportunity of this decade. And that's clearly riding on the fact that India being a very large, heterogeneous, complex, diverse kind of a market, if there's one thing which in a way unifies or binds these different pockets of the market together, it's technology and the ability to adopt technology and implement it and reach out to consumers. So the way we've been playing out in India, there are a couple of ways to do it. One is to say, okay, fine, I just kind of look out for size and scale. I don't care if there are profits or cash flows. So that's one path to take. And some of the recently listed IPOs clearly fall into that bucket, where they have the size, they have the scale, but they don't yet have a path to profitability. Let me put it this way. On the other hand, there are pockets which essentially may not be huge, but these companies out there have been challengers and they are emerging to be champions, homegrown champions, are using capital more efficiently and and they have profits, they have earnings, and they have the cash flows to fund future growth. And we are essentially taking the latter kind of path rather than the former. So we're still basically saying is that show me the money. In the sense that we're saying, yes, the total addressable market may be huge, but where's my math, which is margins after transactions, money after transactions? Show me that. And that's the path we are taking. And therefore, we've been owning businesses. So we have about 3 to 4 companies in this space, which essentially are challengers, champions. In a way, 1 or 2 of them are leaders or amongst the top 3 players. And they have a cash-rich balance sheet, they have profits, and they have the cash flows. And that's the path we are taking yet. It doesn't mean that we are completely negating, the former set, which essentially is the guys who build the scale but don't have yet the path to profitability. If down the line, if we see a path to profitability, we would be happy to kind of take a slightly preemptive call and invest into them. But today, I don't think we have yet built the conviction to basically invest into them. Number one. Number two, the valuations there are still way too high. There has been a party going on, and I think if there were to be an interruption in that party, we would be happy to kind of, at that point of time, step in and take a more constructive view of that opportunity.
Fair call, Nilesh. So am I to assume, therefore, that I mean, I don't want to get into names, but I'm just using them as an illustrative example, that for now, you're not quite looking at the Zomatos, Nykas of the world, because the path to profitability will not be very clear. You're looking for another set of names, but it doesn't mean that those are out of the equation. Is that the summation, so to say?
Oh, absolutely. As in life, well, I mean, you can't rule out anything. I mean, I clearly believe in the investment world. All of us have learned our lessons and have learned it the hard way. And, so to that extent, like, Neeraj, like 20, 25 years back, people would say, why should I own HDFC Bank? There is SBI out there and all of that. And guys who took that call and lived with it paid a huge price for it, right? So similarly, I mean, whether it is Paytm, whether it is Nykaa, whether it is Zomato, these are outstanding businesses. What they have created is truly remarkable. And some of these companies will clearly redefine or probably define the decade going ahead. But there will come a point of time, I mean, over the course of maybe next few months, next few quarters, there will be some point of time where either the market gives you that opportunity or these companies themselves disappoint and they just have one or two bad quarters, and where these stock prices could correct meaningfully, which gives you a very, very attractive entry opportunity where you get them to then own them with a multi-year or a multi-decade kind of an outlook. So to that extent, we will watch the space and we will try and remain constructive.
Nilesh, what about IT services? I've been meaning to ask this to you. I haven't spoken for long, but I hear varied arguments, all of which seem to be extremely strong in their own ways, both on the bull side and the bear side. And I hear the companies, at least the mid-sized one, or not mid-sized really, but the non-nifty ones, who say that they see 2-3 years of anywhere between 12 to 20% growth as well. So the growth certainly seems to be there for select band of companies. How are you looking at this space? Because it suddenly turned out to be this world-beating space, isn't it? Everybody wrote IT services off so many times, and here they are looking like, smelling like roses.
Yeah, absolutely, Neeraj. And clearly believe that, again, in a way, the Indian IT services companies, again, have been a story of global digitalization, in the sense that, businesses worldwide, consumers worldwide, adopting digital technology to basically pursue their interests and grow their businesses. And clearly, Indian IT services companies have been partners in a way achieving that goal or achieving that, in a way, if I may use the word mission. In the process, of course, some of these companies have done remarkably well. The sector as a whole has done remarkably well, partly aided or significantly aided by basically margins, because they've not had to spend on marketing and travel and all of that. Two is basically a strong dollar has given them the extra cushion in terms of margin. So both these factors have been drivers of the margins. Going forward, the way I look at it, Neeraj, is that clearly valuations now are stretched, especially among the tier 2 names. When I see companies trading at 40, 50, 60, 70p multiples to trailing earnings, these are high, not just by historical standards, but they're high just in absolute terms. And, currently, while the growth outlook is very, very strong, but maybe there will come a point of time, a year, 2 years, 3 years later, when the growth outlook may not look as resilient and robust as it is now. I mean, we have to keep in mind that today, of course, there is adoption of technology, which is driving, business and driving revenues. But at some point of time, the technology adoption will become more ubiquitous, more universal, more widespread, and therefore it would become a highly penetrated kind of, in a way, opportunity, and we'd have to wait for that next big leg of technology, which could again be many years down the line. But there will come a period, a hiatus in between, where these businesses may not be able to sustain a double-digit growth rate. and the markets will in a way move ahead and price that accordingly. So my view is that currently I would probably be more neutral on it, in the sense that in a way positive on business outlook, but a bit cautious in terms of the valuation. So on the whole, I would probably just be neutral. If at all there would be further appreciation in stock prices, maybe it's an opportunity to start trimming, start exiting. And if, of course, there were to be a correction in their stock prices, a meaningful correction, maybe then that's again an opportunity to basically load up and buy into these things.
Okay, so suffice to say that you actually essentially playing the valuation game right now out here. Maybe you have companies which are not exorbitantly priced or egregiously priced. And if they were to move to that band, then you might be happy selling them off as well.
Yes. Just one caveat here, Neeraj, that what I've seen is that there are still some of these mid-cap or tier 2 companies which still are in a way bordering around margins of 13 to 14%. Now, if some of these companies can do a bit of inorganic acquisitions and in a way create some additional skill sets or get some additional customers or gain some domain knowledge, number one, and can move up their margins from 13-14% to maybe say 17-18% over the next 2-3 years because of a bit of added offerings that they are having, a bit of scale, and all of those benefits coming, then maybe those would be exceptions to this outlook. So I clearly believe that watch out for companies where margins are still maybe sub 15%, but have the ability to in a way trend up more towards the 18% kind of margin range. If that were to be the case, maybe they still remain buys.
Viewers, do note this: Nilesh is one of the earliest identifiers of mid-sized businesses which have gone on to become great companies, persistent. I remember you, Nilesh, you were one of the first ones back then who told me to look at this company closely on air, by the way. It was pretty interesting. Okay, Nilesh, the other point is deleveraging that you mentioned, right? The other D. And I mean, please correct me if I'm wrong, but are you suggesting that because the corporate balance sheet is delevered, companies can do capex, and therefore sectors which have growth or companies which cater to this whole capex theme would turn out to be big beneficiaries?
Oh, absolutely. I mean, clearly, I believe that what deleveraging does is, of course, that in a way, on one hand, companies which are leveraged and are going through a process of deleveraging, they have the ability to expand and grow, and therefore, I believe that the suppliers or vendors of capital equipment essentially are going to be huge in a way opportunities for investors like us. That's one. And two is, of course, on top of that, if there's an overlay of decarbonization, then that's the icing on the cake, because then companies need to essentially have a decarbonization strategy, and that is going to drive additional investments. So in a way, a bit of deleveraging and decarbonization go together, where decarbonization now has become a corporate imperative. So these two opportunities put together in a way are materializing around the same time, in the sense that where companies need to invest and their balance sheets have become more accommodative because of deleveraging. And on top of that, the cost of capital has come down. I mean, we've never seen interest rates as low as these, what they are right now. So all in all, number one, the need to invest, the ability to raise capital or borrow capital and seize the cost of that capital. Essentially, all three factors are playing out beautifully at the same time. And therefore, again, this again presents a medium-term kind of an opportunity for investors.
I can understand the capital equipment suppliers piece. You've spoken about decarbonization now twice or thrice. Can you talk a bit about that? Because I don't think too many people would even know how to play about this. Should it be direct? Should it be indirect? Could it be financiers? Can you talk a bit about this?
Yeah, absolutely. I mean, if we were to kind of look at decarbonization, I mean, at the first level, this is more about, it's not just about ESG, but obviously something which is more specific and in a way borders or is really clearly a part of, say, the energy producers and companies which are dealing with, in a way, crude and dealing with thermal energy and all of that. And there's clearly now a need. And of course, India as a nation has announced that it basically has set some really nice deadline regarding decarbonization and becoming a carbon neutral nation and things of that kind. So what you're going to see now is incredible amount of investments happening around renewable energy, around solar, around wind, and in terms of basically then creating an entire transmission and distribution network to basically be able to transmit that kind of energy. So those are the kind of plays which essentially will be significantly beneficial. And I'll just give an example that we own, and that's essentially our largest holding in our PMS, which is called ABB Power Products, which is now called Hitachi Energy. And this is a company which essentially, of course, at the core level, just makes basically transformers. But keep in mind that transformers you need not just if you're producing thermal power, but you need them if you're producing solar power, wind power, or any other forms of power. And somewhere down the line, even if you're going to produce power from hydrogen, which again, and if I were to kind of look at all the top 3, 4, 5 industrial houses of India, all of them essentially, in a way, have a role to play or have announced plans to basically participate in this journey. And therefore, if a company like Hitachi Energy becomes hugely beneficial because of the demand for their products and solutions, which are essentially going towards, in a way, transmitting this power and managing the grid and things of that kind. In addition to that, of course, they are also trying to have solutions around mobility and data centers and all of that as well. So to that extent, I clearly believe that one needs to pick a business like this, where there is the strong backing of a parent, which brings to it technology, brings to it global markets, brings to it a lot of differentiated servings offerings. And on top of that, of course, a pristine balance sheet. So that's the way we are participating in this whole decarbonization opportunity.
So much like how a lot of people are not buying real estate companies directly, but buying the ancillaries, you're not betting on the companies which are doing the power capex necessarily, but the beneficiaries of the same.
Yes, absolutely. Because the former which you mentioned about or alluded to essentially will need loads of capital to invest, and therefore, and of course, the outcome could pretty much be delayed. That which means you announce a capacity that I'm going to produce an X megawatt or gigawatts of power from solar or whatever it is, or from hydrogen. These are going to involve gestation periods of 3 to 5 years. And so to that extent, you're going to probably see your gratification maybe many years down the line. Whereas, we may not have that. We're not private equity investors. We probably think a bit like them, but we don't have that kind of time frame. Our investors don't give us those 5, 10 year kind of horizon to invest. But having said that, at least this is way more, in a way, predictable, a bit more linear, and relatively more visible as well. So clearly we think that these kind of illustrations, in a way, tick the boxes that we're really wanting to kind of do.
Got it. Nilesh, last question or last two before we let you go. You mentioned the demographics part, right? Now, it's been now 6 or 9 months, or at least 12 months that people have been saying, let's play the opening up theme. And it consistently gets hit by a roadblock after the other, the latest being Omicron. Safer, Nilesh, you think, to let it be and bet on it, even if you don't catch the bottom and you miss a few percentage points early in the rally, at least there is predictability. Is that a better approach maybe, or no?
No, absolutely. I mean, Neeraj, the unlocking theme is for real. It's probably back to normal in a way. And we all know that India has achieved tremendous amount of progress in terms of its vaccination program. And so even if there were to be an Omicron or maybe the next variant and things of that kind, I don't see those very stringent, long lockdowns that we have seen in 2020 and a bit of in 2021. So to that extent, yes, of course, there would be some bit of restrictions here and there, but I don't think those are going to be very long-lasting restrictions. There would be more of precautionary kind of restrictions rather than something which is out there to basically, in a way, put a complete stop to travel and movement and all of that. So from that perspective, I really see 2022 is, in a way, a start to basically the normalcy that we were used to prior to 2020. And I think on top of that, consumers, in a way, you could call them as revenge shopping or revenge travel or revenge entertainment or whatever is the right word. But I clearly see out there a whole bunch of businesses which have, in a way, consolidated themselves, strengthened themselves, and in a way improvised the business model to become hugely relevant to a very growing mass of consumers in India. And these are businesses across travel, across hospitality, across a lot of other discretionary spending, which I believe are very meaningful businesses to bet on from at least a 3 to 5 year horizon.
Okay, so what within that are you looking at? Travel beneficiaries? Are you looking at the mall shopping, QSRs? What is it that works for you?
It's been so far more around the discretionary spending, more around travel, hospitality. So we own the second largest OTA, the online travel aggregator, which went IPO about 6 months back. We own that name. We like the fact that it's been steadily gaining market share and essentially is obsessed with profitability, which I think is the kind of DNA that we look for, driven by first generation entrepreneur with essentially the ambition, the agility, and the ability to win out there and make a difference. We've been owning India's largest vacation ownership company, which owns probably 40 to 50 resorts on a pan-India basis, with probably a few thousand keys in their bag, and part of a very, very elite group, a very respected group. So we own that. Third is we've been owning a mid-income home developer out there, and again, we like what they do. We like their focus, and we think clearly that we as Indians are aspiring for larger homes, given that work from home and learn from home and all that are becoming now realities. So we've been owning these kind of businesses. We don't yet own any mall operator. We don't yet own QSRs, because in some of these QSRs, we still see that they are not yet profitable. Competitive intensity is increasing. From just having one publicly listed operator out there, we now have close to maybe half a dozen publicly listed QSR operators. So that's basically the challenge that we see. Versus that, we do own one company which went public last December, which essentially is a supplier or a preferred vendor of buns to some of these QSRs. So in a way, we are playing proxies to that opportunity out there, which is again a good mix of the QSR opportunity as well as, of course, the core consumer staples business in terms of the biscuits and breads. So this is essentially the way we've been looking at the entire consumer demographic, with an overlay of unlocking and back to normalcy.
Got it. Final question, Nilesh. And while you did refer to owning some, give reference, some reference to the old economy in a way, but what about the large old economy pockets? Steel, which had a fabulous cycle from the lows, or cement, or oil and gas, wherein the common refrain that I see in all reports is that the companies are pricing oil at $40 to a barrel, but actually crude is $70 to a barrel. So the profitability will go up, gas profitability will go up, so on and so forth. What are you doing with this old economy pack, if you're doing anything at all?
So the old economy is a bit of a cyclical kind of a stuff. It's cyclical as well as capital intensive. So we've essentially not been terribly overweight in this segment. But Neeraj, we've been owning a cement company, which we have been trimming in these recent rallies, because we clearly believe that valuations are heady. We have been owning a company called Carborundum Universal, which makes refractories, abrasives, and electromagnetic minerals. But clearly now valuations have turned heady. It's now trading at almost 50 times trailing earnings. So we've essentially chosen to take money off the table, and we've been trimming for a while, but we've now completely exited that position. So I clearly believe that that's in a way a space that we no longer as optimistic or constructive as we were 12 or 18 months back. But if we were to kind of just use the word old economy, I think one segment is going to fire up and start posting significant essentially growth, because again there exists a pent-up demand out there. So we're getting very, very constructive on both OEMs as well as essentially the autocoms. And of course, there is the new economy kind of overlay to that, which is in the form of EVs. So some of these companies will have a very strong EV strategy, and we would want to participate in that. And then, of course, there will be their preferred vendors through auto component companies, which essentially have a very, very clear-cut EV strategy to partner with these OEMs. And we would want to essentially, in a way, participate in that growth opportunity as well.
So do you bet on eating oats, or do you bet on the oats themselves? Yeah, you believe incumbents stand a chance?
We just bet on growth, earnings, and cash flows. I think the name doesn't matter. Like oats and meals, I think the taste should matter. That's it.
Well said, Nilesh. Well said. But thank you so much, Nilesh, for joining in and giving us a sense of nearly. I mean, I think I made you talk about almost your entire portfolio. So thank you so much for being so open and giving us a sense of how you're approaching this investment.
Thank you, Neeraj. Thank you so much, and wish you great times ahead.
Thank you to you too, and have a great 2022. And viewers, thanks for tuning in.